Thank you.
Okay, I got a message saying it's being recorded. Fantastic. Thanks, Peter. So again, thanks everybody for taking time out of their busy schedules to be here this morning and to give up your Saturday morning. As Peter said, we're going to talk about the truth about money. One of the things that I've enjoyed in over 30 years of being in this business is helping my clients, helping advisors teach their clients the truth about money. And there's so much misinformation out there. So many opinions and half-truths that bombard us daily through the print media, through the internet, through television, that oftentimes it leads to a great deal of confusion. And so what I try to do, what Peter does, what his team does, what we try to do is make sure that we help our clients from an educational standpoint understand the truths about money. And there's 4 that I'm going to cover this morning, and we'll stop, as Peter said, after each section and see if there are any questions. So let's go ahead and get started. So the first truth that I want people to be aware of is that most people, when we look at their financial plan or their financial situation, we get their information, what we find is it's not properly protected. So what does that mean? The best visual that I can give you for what that means is what I find is that most people and what they're doing with their money is based on the assumption that they live in this world, that it's a nice, smooth path, it's a nice, smooth journey to the end. Obviously, in the world we've lived in the last 2 to 3 years with COVID and the markets and election changes and all kinds of stuff, the world isn't constant. It's not smooth. This is more like the reality, the visual of storms and pitfalls and challenges and things that everybody goes through. And so what we have to make sure is that not only do our people protected, but we've got to make sure that their money and what they're doing with their money and the products and the planning are protected as well. And so one of the things that I like to do, and I want you to consider, this would be a question I would ask you if I was meeting with you one-on-one, is when it comes to protecting the things that are most important in your life, I'm going to assume your family, your lifestyle, and your money are probably at the top of the list of the things that are most important to you. The question is, do you want failure in regards to how those 3 things are protected to be an option? Well, I'm sure all of you on the phone, or excuse me, on the call today would say, no, absolutely. We do not want failure to be an option. And so what we have is the ability to use our model to help people discover whether they or their advisors or their team of people have intentionally or unintentionally introduced failure. So before I move on, let me share with you just a little bit about our model. The model is basically broken up into, and you're going to see it later even more, is broken up into different file cabinets. Okay? So when we think about file cabinets, you think about getting organized. Well, that's one of the things that we do with our model, is that we make sure that we get clients out of the junk drawer world they're living in, where some stuff's at the bank, some stuff's at home, some stuff's at their office. It's kind of spread all over. And so when we look at these 9 drawers here, this has everything to do with how your wealth, how your assets, how your family, how your lifestyle are protected. When we go to this area of the model, this is the savings part of the model. Okay? So whether you're saving money at the bank in short-term instruments like a checking, a savings, a CD, a money market, or you're looking at more long-term savings, where we're looking at 529s, Roth IRAs, qualified plans, pensions. And then what we have in this bottom file cabinet, this is what we call the growth file cabinet. When we look at investing in bonds and equities, stocks, mutual funds, collectibles, real estate, maybe a business. So one of the things that we have is we've got a model where we can take everything that a client's doing, put it in its appropriate place, and all of a sudden the client goes from that junk drawer stuff spread everywhere to now we see everything organized on the model in protection, savings, and growth decisions. So one of the things that I like to do is actually divide the model in half. So if I draw a line right here, what we see is everything above this line is what we call the defense of the model. Everything below this line is, to use athletic terms, the offense of the model. So obviously, in order for someone to be financially successful, they have to have a balance of both. We don't want to have, to use an old visual, of a castle with a moat around it. We don't want to have an impenetrable moat and have a tent in the middle of it. But on the other hand, we don't want to have this beautiful, luxurious castle with no moat of protection. We've got to have a balance of both. And so what we find is when we gather information, we gather data. When I ask you to think about your own personal situation, my guess is offensively, what you're doing below this line is very well positioned. My guess is you're doing a lot of great things in regards to retirement planning. You and your employer are probably putting money in, and you're getting money from your employer through a match on your qualified plan. If you have school-age children, you're probably doing a lot with 529s and funding for college. Most of you, I imagine, have some money invested in stocks or mutual funds. My guess is most, if not all of you, have and own your home. So you're doing a lot of great things offensively, and you should be very proud and pleased with that. But when we're talking about balancing between offense and defense, where Peter and I see most people having a problem is not on the offensive side. They're well on their way to reaching their maximum financial potential by the time they retire. Where we see the problems are on the defensive side. And really the initial value and benefit we bring to our clients is as their defensive coordinator, to make sure that they and their team of advisors have done everything possible to eliminate failure. So let's look at some different areas where failure may be an option. And I kind of want you to think about your own personal situation when you think about what you've done or haven't done in this area. So one of the things that we see is that people are not prepared in the event that they're involved in a lawsuit. So I'll give you a statistic. There's a lawsuit being filed in the United States every 32 seconds, and the average award, if you lose that lawsuit, is $1.8 million. That's just statistics. It's kind of sad that we live in a world where reality is people are suing each other over ridiculous stuff, and it's every 32 seconds, and if you lose, it's $1.8 million. So the question is, what would happen to your family? What would happen to your lifestyle? What would happen to all of these assets down here if you were involved in a lawsuit? Are you prepared? Have you eliminated failure when it comes to that protection? Next, when we think about a change in your health, a disability, a long-term care event, are your family, your lifestyle, your assets protected in the event of a injury and illness that causes you to lose your income or a portion of your income, or to take on added expenses through long-term care? Is that something that you're prepared for? Next, when we look at our clients' wills and documents, do they know who's going to get all of this wealth down here if something were to happen to them? Do they know when they're going to get that wealth? And do they know the amount that they're going to get? So when we think about wills and documents, and I don't know when the last time you reviewed them, or maybe some on the call don't even have wills and documents. If you don't have a will and document, you're basically saying, I'm okay letting the courts to decide who's going to get my money, when that person is going to get it, and the amount that they're going to get. I doubt you want the courts making that decision. I'm sure that's something that you want to do. And do your wills and documents answer those questions, reflect your desires with all of this wealth that you're creating down here in a way in which you won't? If not, we would look at that as that's an opportunity for failure, for a mistake, for conflict. Next, when we look at life insurance, there's no amount of money that can replace somebody as a husband, a wife, a spouse, a parent, a grandparent. But what we can do is look at the role of life insurance to replace someone's what we call economic life value. What is the economic impact to a family? So in the event of their premature death, will they be able to keep their real estate? Will they be able to continue to fund and prepare for retirement for the surviving spouse? Will children still have the funding and the ability to go to college? Will assets in the market have to be liquidated because of the lack of life insurance? So there's a balance of assets growing to protection of someone's economic life value, and that would be protected by the amount of insurance. If we don't have the right amount, failure has been introduced. What we find a lot of times is when we look at what somebody has at the bank, if there's an emergency, one of the things that we find is people don't have the right amount of liquidity. And when I say the right amount of liquidity, sometimes it's what we have here, it's not enough. Sometimes what we have is people with too much. They have too much liquidity, sitting at the bank earning less than 1%. So when you think about liquidity, here's kind of a range I would like for you to think in terms of. At a minimum, we would suggest that you have 3 months of your living expenses. That would be the minimum amount of liquidity. The maximum amount of liquidity that we would encourage you to consider having to protect your family, your lifestyle, and your assets would be 1 year of your income. So somewhere between this minimum and this maximum is a number that you would, in your world, your comfort level, your financial situation, your family situation, you're going to determine what that number is, and you simply need to make sure it's in a liquid position at the bank. If it's not, we need to build it up. If it's too much, we need to move some of the excess away. And then the last area that we see is in how people have their debt structured. When we look at debt, and we look at the amount of money that's leaving someone's economic situation in interest and payments every month and every year, we have to compare it to the amount of interest and money that is being added to the model through their investments, through their retirement plans, et cetera. Well, if more money is leaving the model for debt than is coming into the model for growth, then there's no way you're going to reach your maximum financial potential. So I have meetings, Peter have meetings, and sometimes the client comes in and says, you know, I just don't feel like I'm getting anywhere. And we gather their data and we put it on the model. And we look at it and we see that the amount of money that's leaving the model for debt, payments and interest is more than what they're bringing in. And so I understand why they feel that way, because it's reality. But they can't figure out why that feeling is there until they visually see it on the model. So sitting here today, all I would ask you is, when you think about the wealth that you're building offensively, and I'm sure everybody on the call is doing a great job there, and you think about what you're doing defensively, have you done everything possible to eliminate failure in the event of a lawsuit, disability, or long-term care? Do your wills and documents reflect your desires? You have the right amount of life insurance? You have the right amount of liquidity? And is your debt structured where you are in a situation where the debt is structured to where you're winning instead of the lending institution, and how your debt is structured? So, Peter, I'll stop right there and see if anybody has any questions, comments.
While people are typing in their questions and such, we'll leave them some time for that, Al. Can you explain what the right amount of protection would be? Let's start from there.
What the right amount of protection would be? Well, certainly. So, Peter, one of the things when we gather information, let's say that we're dealing with a client and right now their offense is worth, let's say, $2 million. Okay. Well, at a minimum, I would want them to have at least $2 million of umbrella liability protection. So that's something that you have your homeowners, you have your auto insurance. And so one of the things you can do is add additional liability through what's called an umbrella liability policy. If we're talking about disability, certainly we would want to have, and the max amount of income replacement that we can have is somewhere around 70% of someone's income on an after-tax basis. Well, if that's the maximum for disability, I want them to have that. If they're contributing to their retirement accounts and they're getting an employer match, I want to make sure all of those monies would go into their retirement plan, even if they're disabled. Having those questions answered with your wills and documents would be the right design. In regards to life insurance, the right amount is going to be your economic life value. So economic life value is basically a formula. So if you take your retirement age, you subtract from it your current age, and then you multiply it times your income, well, that ends up being the maximum amount of life insurance that you can have. So somewhere between what somebody has currently, their current life insurance, and this economic life value maximum is a number that would take care of their family, would take care of their assets in the event of their premature death. So not everybody's number is going to be the same, but it's going to be somewhere, we find, Peter, between what they currently have and this maximum. We talked about with the liquidity, what's the right amount? Well, it's going to be an amount they choose somewhere between the minimum of 3 months of their living expenses and 1 year of their income. And in regards to debt, it'd be great if there's no debt there, but that's not realistic. And so what we have to do is we've got to make sure that the debt that they have isn't bad debt, but we help them restructure it to good debt by lowering the interest, maybe making the interest deductible, changing the repayment schedule to be in their favor. So those are, again, kind of big picture, Peters, as far as the right amounts in each of those areas that we have questions that we find most clients unintentionally, again, have introduced failure. Does that help?
Definitely. Thank you, Al. I'm not seeing any other questions coming in right now.
Okay.
So if you want to move on to the next one.
Perfect. Okay. So the second truth is what we find is that most people don't have what we call an ideal investment profile. And I think it's very important for people to have that. So if we look at our model, and again, I kind of draw this line, and as we talked about earlier, everything below this line is the offense of the model. And the goal is for everybody to use their money between the now and the day they retire to reach their maximum financial potential, to create as much wealth as possible. That's the goal. Well, in order to do that, what we believe is you should have an ideal investment profile. So here's what I want you to do, and I think this would be helpful if you wrote this down, would be if you could create the perfect investment for you to grow your wealth, to reach your maximum financial potential. Let's talk about some characteristics that you might consider including. So, number one, my guess is this is a pretty obvious one. You would want to put your money into, you would want to reinvest your interest into things that give you a good rate of return. Now, everybody on the call probably has a different definition or different number for what a good rate of return is, whether it's 6, 8, 10, 12, whatever that is. But rate of return isn't the only thing that I wouldn't assume you would want to include. Would it be important to also include risk? So when we think about rate of return, most people think that, well, in order to get a higher rate of return, I've got to take more risk. Well, if we're trying to create the ideal or the perfect investment, wouldn't it be one in which we have the potential for a high rate of return while minimizing the risk, actually including some guarantees? If that's what you would want, then I would encourage you to write that down. Number 3, we would deal with taxes. So if you think about you and your money go through 3 phases of wealth. You accumulate wealth between now and the day you retire, you distribute wealth in retirement, and then you preserve and pass on wealth as you get close to the end of your life. So if this is a timeline of your life, you and your money go through 3 phases. Well, when we talk about taxes, you want your money to be in a position where they minimize, avoid taxes as they only accumulate wealth? Or would you want to minimize and avoid taxes also when you distribute and enjoy your wealth? And do you want to minimize and avoid taxes when you preserve and pass on your wealth? My guess is it would be all 3. Next, do you want to be putting money into, compounding your interest into an ideal investment where you have flexibility? Obviously, the world has changed a great deal. It's going to continue to change. So as the world changes, do you want to have the flexibility to avoid or take advantage of those changes with your money? If so, that would be an ideal and characteristic to include. Part of flexibility is liquidity. Whatever's ideal today, something else is going to come along in the future, and it might be more ideal. Do you want to have the liquidity to move your money from one to another? If there's a change in the tax law, do you want to have the liquidity and the flexibility to move your money to a different situation without having to pay a penalty, without having to be subjected to additional fees, maybe subjected to additional taxes? Would that be important? If so, that would be on your list of ideal characteristics. Number 6, we all live very, very busy lives. In fact, it's gotten even busier with COVID and working from home and all that goes with that. So most people like things that are easy. They're automated. They're not having to run to the bank on a regular basis, or they're not having to take time and go to the internet and move money around. They like things that are easy and automated. And if that would be important to you as part of an ideal characteristic, we write it down. So if we stop right here and we kind of think about what is potentially the characteristics you've written down for an ideal investment: good rate of return, minimum risk with guarantees, minimize or avoid taxes during all 3 phases of my life, flexible and liquid, and easy. If you were putting your money into something that had all of those characteristics, if you were compounding your interest into things that had all of those characteristics, my guess is number 7 would be you would want to protect that investment. Well, protection, kind of the big 3 for protection, as we talked about a few minutes ago, is lawsuit. So if I'm on the wrong end of a lawsuit, does this ideal investment and the money going in, does it get affected? If I'm disabled, does it stop? Does the funding stop? Do I have to liquidate this ideal investment to make up for a deficiency in the protection that I have for disability or long-term care? What happens if there's a premature death? Does the family I leave behind, does the spouse I leave behind continue to be able to take advantage of these ideal characteristics? So when I think about and talk about, and Peter thinks and talks with his clients about helping them reach their maximum financial potential, before we talk about anything specific that someone's doing with their money, with their interest, doesn't it make sense for us to come up with an ideal, with a standard, with a target of what we're trying to accomplish? Now, how we do that, use these ideal characteristics, is let's look at all of them. And you may not have written all these down, but let's assume that you did. So one of the things that we see, kind of the be-all, end-all, that the world that we live in, when it comes to helping someone reach their maximum financial potential before retirement, is to put money in a tax qualified retirement account. Because they're putting money in a qualified plan, whether it be a 401k, an IRA, something that is tax qualified. One of the things that we see is, yes, that qualified plan does give them the potential for a good rate of return. No, there's typically nothing in the plan that guarantees them a rate of return. Yes, it does allow them to minimize or avoid taxes as their money grows. But when they pull that money out, they do have to pay a tax. And when they pass on that qualified plan to a beneficiary, that beneficiary does have to pay a tax. There is flexibility within the plan with the different investment choices that you have available. But in the event of an emergency or other situation where you needed to liquidate it, there's guidelines and restrictions for how you would do that. Yes, it's really easy in how you get money into it. Typically, they'll take it right out of your checking account, your pay stub. And yes, it is protected. Don't know if you knew this or not, but your qualified plan in the event of a lawsuit is one of the areas of the model, along with permanent life insurance, that are protected in the event of a lawsuit. But nobody's going to fund it if you're disabled, and nobody's going to hand your beneficiary a large check for what you would have built in your qualified plan if you die prematurely. So kind of the be-all, end-all for building wealth in a retirement plan, the thing that everybody's telling everybody to do in regards to these ideal characteristics have some yeses and some nos. Well, what Peter and his team do, and what I do with my clients, is there's nothing wrong with the qualified plan. It's got a lot of great things, all these areas where they're accomplishing the things that you're looking for, but it has deficiencies. So what we do is try to help our clients take the same dollars and put them in a strategy where all of these ideal characteristics are included, not just some of them. Because the more ideal characteristics we include for every dollar that you're putting in, the closer we're going to get to you reaching your maximum financial potential. So as you think about what you're doing with your money, how you're investing it, what your decisions you've made to help you reach your maximum financial potential, how are those decisions, how are those products, when you compare them to your list of ideal characteristics? Do they meet all the ideal characteristics, or are there a shortfall? If there's a shortfall, then there's an opportunity to make it better, to think about a strategy that you could wrap around those things to make all of those ideal characteristics you're looking for possible. So Peter, I'll stop again. Any questions, any comments?
Sure. We did get one question from Rosemary Walker asking
Yes.
you to explain the debt window.
Okay, absolutely. Thank you. So I'm going to go to a different page real quickly, Peter, and I think this will be easier. Okay. So Rosemary, great question. So this is a little, this is actually a copy of the model that we use. So I'm going to zoom in here, Rosemary, and see if I can make this a little bigger for you. So when we talk about the debt window, okay, and what we're talking about here in regards to debt, it could be a mortgage, could be a car loan, maybe it's an education loan, maybe it's a credit card, whatever the client is doing that they owe money on, whether it be a mortgage, a car, an education. What we want to know is, what is the interest rate they're paying on it? How many months left do they have before that payment or that debt is exhausted? What are they paying on a monthly basis? And what is the unpaid balance? And once we have that information in regards to rate, months left, monthly payment, unpaid balance, what we can look at is there's really, Rosemary, three types of debt. There's obviously no debt, there's bad debt, and there is good debt. Bad debt is our focus. That is really the problem area. And bad debt would be any time you have a debt where you're paying a high interest rate, the interest you're paying is not deductible, and you have a short repayment schedule. The shorter the repayment schedule, the higher the payment. The higher the payment, more money is leaving your model. So if somebody has bad debt that fits one or more of these characteristics, Rosemary, what we're trying to do is help the client, if they can, take it from bad debt to no debt by paying it off. If that's not a possibility, then what we look at doing is, can we restructure that bad debt to good debt by lowering the interest rate, maybe making the interest deductible, changing the repayment schedule so that it is in the client's best interest? So first we have to get their debt, then we step back and look at the rest of the model and go, okay, with other decisions that are there. So sometimes, Rosemary, we find that clients have extra money sitting at the bank above their liquidity goal, and they really don't know what to do with that extra money. Well, when we gather their data and we look at the model and we see that they have some bad debt, then we look at maybe some of that extra money coming down here and helping us to pay off, to restructure their debt. Hopefully that answers your question, Rosemary.
Great, Al. We also got another question. Just to preface it, Greg Lupion asked the question about annuities, both fixed rate and variable. We are not going to talk about products or even make recommendations of any kind. So with that in mind, Al, could you maybe use your ideal characteristics and kind of run through that and maybe answer the question generally?
Yeah, absolutely. And I think, you know, whether, you know, in the model, annuities are in this area of the model. And so what we would do is we look at annuities and go, yes, you know, they do have the potential for a good rate of return. Now, it depends. In some of the annuities that you have an opportunity to choose, yes, they do have some guarantees. Typically, when you look at the annuities, depending on how they were set up, they may or may not have taxes that are due. We look at annuities as not really having a lot of flexibility or a lot of liquidity. Yeah, getting money into it's pretty easy. The company that you're investing with will take your annuity money every day. If it's part of a qualified annuity, meaning part of a retirement account, yes, it is protected in a lawsuit. You know, if you don't have enough funding, enough protection in the event of a disability, that annuity might have to be liquidated early to take care of a disability that you're not prepared for, and kind of the same thing in the event of a premature death. So annuities are great products, just like a qualified plan is a great product. But when we compare it to the ideal characteristics, we see different yeses and different nos. And so what we try to do is, what could we wrap from a strategy standpoint around the annuity to where all of the ideal characteristics that a client is looking for would become a yes. Does that help, Peter?
I think so. Greg, let us know if that helped answer your question, and same with you, Rosemary. Hopefully Al was able to answer the debt window question. But no other questions at this point. Greg Lupion did say thank you, so that did help. So thank you for that. So we can move on to the next section now. Okay.
So, and I'm kind of keeping my eye on the time, so we're going to get through this one. And a recent statistic is, you know, somewhere in the neighborhood of 99% of Americans are retiring today with less than $1 million, which is shocking to me. If you think about all the money someone makes, and they don't even have to have a high income, but if they look at all the income they make from the day they started working to the day they retire, it's well in excess of $1 million. So how can people in America be retiring with less than $1 million? Well, what I find is it's because most people don't understand that investing is much like an iceberg. Okay, so let me take you to that, and let me show you what I mean. Okay, so we're going to take an example here, and let's say that we had somebody that was going to save $10,000 a year, and they were going to do it for 30 years. And again, past performance is no guarantee of future results. But if the future is like the last 30 years, they could earn an 11.45% rate of return. That would be the average rate of return over the last 30 years. If they could do that, one of the things that we would see is, let me go here very quickly, to a calculator that would show them that, move something out of the way here. Okay. What that's going to do is show them, let's go here, we'll go 30 years. So I'm gonna go here from 35 to 65, that'd be our 30-year period of time. They're saving $10,000 a year. We're gonna look at that average rate of return of 11.45%. And what we see is they're gonna create, over that 30-year period of time, almost a little over $2.4 million. Okay. So all we did is verify that someone that had the discipline for 30 years to save $10,000 a year and they got an average rate of return of 11.45, they're going to not be one of those statistics. They're going to be in a position where this decision created $2.4 million. Well, I said to you that investing is much like an iceberg. So when you think about an iceberg, there's what you see above the water, and there's a lot of what you don't see below the water. And it's what goes on below the water that actually causes that statistic of people retiring with less than $1 million. And it's actually downward pressure, almost like downward stair steps on that 2.4 that most people aren't aware of. So let's talk about what those are. So one of the things that we have to get them to understand is there's a big difference between an average versus a real rate of return. Let me explain that to you real quick. And this is very important. I want you to pay attention to this. So if we look at the year and we look at the beginning of value at the beginning of the year, we look at the rate of return someone earns during the year, and we look at the end of the year value. So if in the first year somebody invested $100 and they got 100% rate of return, we know that at the end of the year they're going to have $200. In year two, they start with that $200. They keep their money invested, but the market loses 50%. They're back to $100. In year three, they start with that $100, and the market can't make up its mind. It's back up 100%. Well, they're excited, and their 100's back to $200. If in year four, they start with that $200, and the market really can't make up its mind, it's now back to where they're losing 50%. Now they're back to $100. Well, if we look at average rates of return, up 100 is 200, minus 50 would be 150, minus another 50 would be 100. 100 divided by the 4 years, the average rate of return is 25%. But when you start with 100 and you end with 100, the real rate of return is 0. So if you don't take away anything else from our discussions this morning, I want you to stop all conversations around average rates of return. They are meaningless. Let me show you what I mean. If we go back here to this calculator and we said you average 11.45, and I go here to historical rates, and I look at an S&P 500 fund, it could be large cap, so the S&P 500, and I look at a 30-year period of time and a recent 30-year period of time. Let's go out here to 1990. The 1990 to 2020, the average rate of return, as you can see right here, is 11.45%. But the real rate of return is 9.62. So again, if I go here, here's the average, 11.45. If I click on the historical rates for those 30 years, yes, the average rate of return is still 11.45, but the real rate of return is 9.62. 9.62 is not bad. Again, I'm not saying that. I'm just saying it's not. It is 11.45, but the 2.4, when we go from average to the real rate of return, becomes roughly $1.7 million. So the first downward pressure that people aren't aware of is the difference between average and real rates of return. And in this case, somebody loses $700,000. The next downward pressure that people aren't usually aware of and don't understand is the fees that they pay to the company or to the advisor who's managing the money. Now, those fees are typically somewhere in the 1 to maybe 3% range. Well, in my example, let's say we find someone that really is going to do a great job for you for less than the average. They're only going to charge you 0.75, actually less than 1. So let's go back here to our number and see what happens to this $1.7 million when we put in a management fee of 0.75. So when we put in a management fee of 0.75, our $1.7 million number became around $1.4 million and some change. So basically, they lost $250,000 of their money because of the fee. Next, what about the taxes? Now, taxes could be paid on the money as it goes in, the money as it grows, the money as it comes out, one of those, all of those, etc. So let's say that this is a non-qualified account, and I'm going to be generous, and let's say that taxes are only 20%. Well, let's see what the impact of taxes are. So we're going to go back here. We're going to put in that tax rate of 20%. We're going to pay the taxes from the fund, whether you pay it outside and then deduct it from the balance or you pay it from the fund. It doesn't matter. I'm just going to net it out here and pay the taxes from the account. And now our $1.4 million and some change has become $884. So taxes have cost this account over $500,000. So $540,000 has been lost in taxes that were paid, and the tax rate's only 20%. And the last downward pressure is a lot of people are taught to buy term insurance so that they can invest a majority of their money into the market. Okay, well, let's say that the premium for a term policy, a 30-year level term policy, is $1,000 a year. But what we see is, go back to this calculator, we put in that term cost of $1,000. We net it out of the account. And now what we have is around $795,000. So the importance of this is you understanding that these downward pressures cause this account to end up with somewhere in the neighborhood of $795,000 on a net after fee, after tax, after term, looking at the real rate of return. So where someone got all excited early in their life about investing and the potential of creating 2.4, when the real world impacts that account 30 years from now, they don't end up with 2.4. In this case, they end up with 795,000, and they're just another statistic. So here's the question. Is the question that this client didn't save enough? I would say no. Is the question that this client didn't start early enough? I would say no. Is this question, is the problem that this client didn't get a good enough rate of return, whether it's 11.45 average or a 9.62% real? Either one of those are attractive over a 30-year period of time. So what's the problem? The problem is the client doesn't understand how to use their money in a strategy, where they reduce or eliminate fees, where they reduce or eliminate taxes, where they reduce or eliminate the need for term insurance. See, if that strategy allowed the client to get all or a portion of this money back, all or a portion of this money back, all or a portion of this money back, and we add it to what they're going to create, they'll get closer to, in this case, their maximum financial potential on this $10,000 a year for 30 years. So when you think about what you're doing with your money and the investments that you're involved in, are you talking about average or real rates of return? Have you had a conversation about the fees and the impact of fees? What are taxes doing to your fund now, along the way, when you pull money out? And do you have other costs, for example, like term insurance, that have an impact on the net growth of your account? So, Peter, I think that is everything there. Any questions, any comments?
Please feel free to type in your questions either in the chat or the Q&A box. I am not seeing any questions at the moment, Al.
Okay. I know, Peter, we said we want to stop at about 10:50 for questions. I didn't get to the fourth one. Do you want me to stop and see if there are questions or go to the fourth truth about money?
I think let's go to the fourth one, Al, and then we'll wrap it up with Q&A. Okay.
So the fourth truth is, Peter finds, I find that in our work with clients that people are wasting 1 to 5% of their income, and they don't even know it. So how is that? Well, if I take every dollar of income that you make, every financial product that you're involved in, every financial relationship that you're involved in, if I take those and I put them here inside of this circle, think of this circle as our model. Our model includes everything you're doing in regards to paying taxes, everything that you're doing in regards to monies that you're paying to financial institutions through insurance premiums, mortgage payments, retirement contributions, college funding strategies, and there's money that you keep for your lifestyle. Well, if we look at it, most people, their model, their financial situation is their money is basically divided up into thirds. Roughly a third of it's going to the government in the form of taxes. Another third is going to the financial institutions. And the remaining third is what they spend and live and enjoy for their lifestyle. Well, what we find is through our model, getting people organized, looking at everything they're doing, we find that people are paying more in taxes than they should. And we show them where that is, what they can do to stop doing that. And when they stop doing that, that's money that they no longer are paying to the government, they're actually getting to keep. We educate them and teach them about every financial product that they own and make sure that it is a product that's as economically structured as possible, make sure their debt structured properly, make sure they have the proper deductibles, et cetera. And oftentimes what we find is they're paying more to financial institutions than they should. We make changes in their model, and that allows them to recapture monies that they're currently wasting. So what we find is typically clients are wasting 1 to 5% of their income to the government, the financial institutions, and they didn't even know it. Why didn't they know it? Because they don't have a way to look at all of their financial decisions on one sheet of paper to see how they're working together or in conflict. So I'll give you a real simple example of where people typically are wasting their money. So I was working with a couple the other day, and when I gathered their data, one of the things that they had was in a money market account, They had $25,000. In their car insurance, they had a $100 deductible, and they were paying the premium for that $100 deductible. And so I asked them the question. I said, if you had an accident, it was your fault, and let's say that you did $1,000 worth of damage to your car. So you need $1,000 to get your car fixed. Would you go to your money market account and take $1,000 out of there and get your car fixed? Or would you go up here, turn in your claim, pay your $100 deductible, and get your car fixed? Now, this client said, Al, that's easy. We would go down here and we would take it out of our money market. Well, my question to them is, why would you do that versus turn the claim in? And their response was, well, our property and casualty advisor told us that if we turn a claim in, our premiums are going to go up. We don't want our premiums to go up. We have enough liquidity to pay that $1,000. Well, that led us to a continuation of the discussion going, why then are you paying more money to a financial institution for a deductible you are not going to use? Wouldn't it make sense to call your property and casualty advisor, change your deductible to the amount that you would self-insure to, and in doing that, that's going to cause your premiums to go down, which would in turn create some savings. Now, in their situation, we took that savings that we created by changing their deductible. We took those savings over there and we used it to pay the premium for $1 million of umbrella liability. So without them having to pay $1 more, they kept paying the same amount of money. We just used it with a deductible that fits their liquidity position, and we included liability that they didn't have. It's a real simple example, but those kind of opportunities present themselves everywhere in the model when we're able to look at all of the financial decisions that people are involved in one drawer, compare it to another drawer in the model, and they're either working in concert or they're working in conflict. They're in conflict. That's where we find, Peter, most of the waste. Does that help?
Yes, most definitely, Al. Thank you. Well, we have a
Absolutely.
few more minutes left for questions, and if we do go over a bit, is that okay, Al?
Absolutely. I've got a tea time at 1 o'clock, so I'm fine.
All right. So well, everybody only has so many dollars, and with the taxes, financial institutions, lifestyle demanding our money, any suggestions on how to prioritize dollars?
Yeah, absolutely. So that's such a great question, Peter. So I'm going to go here, and we're going to go back to the model. So one of the things that we talk to our clients about, Peter, is this. Most people are asking this question. And the question they're asking is, where should I be putting my money? Where should I be putting the interest that I've already invested money in, the interest I'm earning? What should I be doing with it? And one of the things I tell people is you're actually asking the wrong question. Instead of where, you should be talking and asking about this question. The question should be how. See, when you're asking the question about where, you're basically saying, tell me the product that I should be putting my money into. Tell me the product that I should be compounding my interest into. Well, I want you to think in terms of creating a financial plan, creating your financial future is very similar. The analogy is to building a home or doing a renovation. Well, if you're building a home, a new home, or you're doing a renovation, the first thing you don't do is go and buy products. You don't go, okay, well, we're getting ready to build a house on this lot, or we're getting ready to do a renovation, so let's go buy all the roofing materials and all the lumber and all the nails. Let's just go buy a bunch of products. Nobody does that. What they do is they hire an architect. And with the architect, they design exactly what they want, the dream home or the renovation or whatever. Now, the architect, from all the training and all the knowledge they have, they know about how to build a home or do a renovation based on structural integrity. Well, to use this architect analogy, there is a way that you build the perfect model or a model with economic integrity. So an architect looks at structural integrity. What we look at is economic integrity. And that is the most important thing, is in teaching you how to put your money. So for example, first thing that we're going to look at is, in regards to protection, is there anything here where failure is an option? If so, then money should go there first. Once we've done everything possible to eliminate failure, then the second step of building a model with economic integrity is we want to go here to step number 2. And we teach our clients that this is the parking lot of the model. So at that minimum of 3 months of your living expenses up to 1 year of income, whatever amount that you want between those two, if it's not, you don't have it, then money needs to go there to create it. Once we've taken care of the parking lot, then what we do, Rosemary, is we go down here to the debt window. Is there any bad debt? If possible, can we pay it off? If we can't pay it off, can we use some of the money that we're saving to pay it off? Is there a way to use our money to restructure it from bad to good? Or maybe I have good debt in the form of a mortgage, but I would love to make it better debt. Once we've taken care of debt and making sure it's properly structured, then we have the permission to step number 4, to begin to look at where money goes and how it goes into things that fit the ideal ideal investment characteristics, so that the client's on a path to reach their maximum financial potential. So, Peter, a lot of what we do is not talk about products. That would be asking and answering the question, where should I put my money? What we really try to help clients understand is much more about the strategy to build a model of economic integrity, and it's the how. And if you really think about this, step 1, protection, step 2, liquidity, step 3, debt structure, step 4, long-term wealth building towards your maximum potential, it's very, the analogy would be like, think about driving a manual transmission car. Well, you would never put your key in ignition, start out, and just leave the car in first gear. You can't go very fast, and it's never going to reach your destination, or you'll get there, but it's going to take forever. Well, that would be like just focusing on protection planning. That'd be like driving around in first gear. But on the other hand, you would never put the key in ignition, pop the thing into 4th gear to get started, because as soon as you pop the clutch, the engine chokes out and you don't go anywhere. Well, that would be analogous to starting out this area of the model as number 1. I'm going to focus on long-term wealth building first. Well, just like we talked about in the very first section, is people that do that oftentimes have introduced failure in regards to protection, lack of liquidity, the way their debt's structured. So a lot of times what we have to do, Peter, in helping clients understand how to work with their money, how to build a model with economic integrity, sometimes we have to downshift and we got to go back and reorganize it and make sure first gear is taken care of. Then we move to second gear is taken care of. Let's move to third. Once third gear is taken care of, now we can go back into long-term wealth building in 4th gear. Does that help, Peter?
That was perfect, Al. Thank you so much. Well, we have 11:05. We want to thank Al for his time out of his day on a Saturday to share with us the education. I thank you all for taking time out of your day to be able to attend our first in what we hope will be a series of these webinars. On Monday, you will receive an email with the recording. I believe in the email, it also gives you an opportunity to complete a form if you're interested in a one-on-one with Al. So thank you everybody so much. And hopefully you took some things away from today. Al, hit them straight this afternoon. And
Well, thank you.
thank you, everybody.
Appreciate it. Everybody have a blessed Easter. Thank you so much.